So, Jim, let's start from the top here in terms of just kind of the macro relevance of the Federal Reserve's central bank meetings right now and FOMC. Is this at this point just for the Fed walks out there to parse through words and phraseology and textbooks, or does this really have market impact? Because I don't see much market impact, Jim.
No, there isn't any real market impact today. I mean, if you want to talk about Fed phraseology, they took their FOMC statement and they used to have a formula that they followed and they completely changed it. It's a whole new statement. It's all about the impact of the virus, and it's all about that the Fed will do whatever it takes. If there was some minor news in the Q&A here today, Powell said, don't get hung up on the size of any of our programs because we'll expand them if we have to. So assume every program's infinite if it needs to be. He also promised that while they haven't bought corporate bonds, haven't bought corporate bond ETFs, haven't bought municipals, and they only announced those programs 5 weeks ago, they still will do it. You know, there's been some chatter that, well, the announcement effect was such a good, powerful force the market's going that maybe the Fed will call them off. But he said, no, they will still do them. That's about the only news we got out of this. It's not major news, but at least it's something right now.
Jim, so to be clear, do they not own any HYG then after all the hand-wringing? They're just talking about the ability to own it?
Yeah, they haven't bought yet. They're still trying to work through the operational difficulties of buying it, but they promised that they're going to buy HYG, they're going to buy LQD, they're going to buy the bonds that are part of HYG and LQD, and they're going to give some companies direct loans if that's what those companies need. They haven't done it yet, and also municipalities too. They're going to be buying city bonds, city GOs. They're going to be buying state GOs. They're going to be buying all of those as well too. It's coming. They promised that it's coming. The Main Street lending program, he did say that that's a little bit of ways away. So direct loans to companies, that's going to take a little bit more time for them to figure out how to do it.
All right, so there is a lot of good stuff in here today. I want to take it step by step here. So, Jim, this is pretty interesting. So for those that were saying, oh, the credit bounce back was just because the Fed was in there scooping up bonds, that doesn't make sense. This was more like a placebo. Like, I feel comfortable because I think someone's doing something. I don't really know if they're doing it. So on the one hand, that might be a good lesson that we're learning here from the Fed's just language, being able to change market dynamics. But on the other hand, what's funny is we were just talking yesterday with Lolly Topcholu at J.O. Hambro, and we were talking about how stocks have run further than credit, but still credit has run further than treasuries off the low. So the place the Fed is buying, which is the Treasury bond market, is actually the most sluggish here over the last month. What the heck's going on? I thought you were supposed to follow the Fed.
You know, that is probably the Achilles heel of all of this right now. If you look at the Treasury market, and I know these numbers are hard to understand, the Fed has bought $2 trillion with a T dollars of treasuries, $2 trillion in the last 7 weeks. They have bought so many treasury securities that we actually, if you X out Fed holdings, we're actually down on the year. We have less treasury bonds available for the public to buy now than we did in January. The market is contracting in size, and yet yields, I would argue that in a normal environment, the 10-year yield would be negative right now. It'd at least be zero. It wouldn't be waffling around 60 basis points. That is a concern. Why? Because everybody seems to be liquidating the Treasury market in a major way. Where are they going? They're going to money market funds. They're not going to stocks. They're not going to more risk. They're going to money market funds. That seems, you know, if that is a trend that continues, the relationship between stocks and bonds is changed. It's not going to go back to the old one. You buy bonds as risk off, you buy stocks as risk on. That relationship might be over with right now. And why? Maybe because the market's sniffing out that over the next year, you have a threat of deflation, but on the other side coming out of this, inflation. And that you have a real risk of inflation. So what could be the Achilles heel of this is we get therapeutics, maybe a vaccine, things get better, and there you go, 5% in the 10-year, and it crushes everything. That could be the fear that we have on the other side, not the fear that we're still social distancing from 3 years later, that we finally produce inflation that we've been waiting for 20 years to come with. And I'm in the camp of be careful, because when you produce that inflation, you're not going to like it. It's been because we haven't had it for the last 20 years that we've had such good markets. That's your risk.
Jim, is that why people are so I don't even really know how to describe it. I mean, I wrote about it as basically like a heresy question where there's almost like a theology that's forming where if you talk about inflation, you're shunned away from the conversation on the ramifications of this. I mean, I think to your point here, it would be probably a better problem than the immediate ones we have right now. But when Jay Powell says stuff today, like, I'm just going to read a quote, that we need to use the great fiscal power of the United States to do what we can to support the economy, right? What he's talking about is the idea that they can do everything that, he's doing, plus maybe even more, and not have to worry about these things to a certain degree. Is this the test? I mean, are we finally here? The last time you and I spoke, you said that the 10-year may have finally made its bottom in yield. Does that look like it's being confirmed with all the buying that's happening by the Fed, but yet still no rally in bonds to new highs?
Yeah, I'm getting more and more convinced that the 39-year bull market in bonds might have ended on March 9th when we hit 30 basis points in the 10-year. Maybe we retest it. But I do think that as we go forward from here, we start to see more and more of these things. He also said, too, now is not the time to worry about federal debt. And so that is almost like a to the MMT crowd, that the Fed is willing to print up whatever they need to print up to give it to the government to spend whatever they need to spend. Look, and I'll even go you one step further. Just a thought thing for you here. Let's say that they've already printed and promised with all of the bailouts the equivalent of 4 years of taxes, 4 years of income tax receipts has been promised to fight this virus. If that doesn't produce inflation, I've heard people jokingly say, can we get rid of the IRS and never have to pay taxes again? Let them just print it up every single year? Because if they can print 4 years of taxes and not produce inflation, why stop doing it? Then at that point, then we're into full-blown MMT. So there's going to be some issues here that the bond market's going to have to grapple with. Is these deficits and is that mentality going to stay there that we could just keep printing and printing and printing and spending and spending and spending whatever we take? And will it produce inflation? Again, as far as inflation goes, I got to remember, not this year, because this year is more of a deflation worry as we go down. But as we recover, because we're going to restart, we're going to go back to work, we're going to go back to our lives, do we get all that stimulus come in the form of inflation on the other side? And I think more and more the bond market's starting to worry that that's exactly what's going to happen.
I got to say, not to go to the far end of the spectrum here, but the things that are up today, the everything trade basically turned into stocks and Bitcoin. And we know what the Bitcoiners think about all that topic. So that thing's moving like wild again today. Jim, what will you be looking for to assess the timing of that potential inflationary bounce? I think that from a just kind of life and activity right now, from that standpoint, it could be just a faster return to activity. But from the actual data, what will you be looking for? Is it a meaningful breakdown in the dollar that suggests that this trend is over? Is it going to be just looking, hey, weekly basis, what do our CPIs tell us? I mean, how will we be monitoring this?
Yeah, I think right now is the time to be looking. And what you want to look at is places like Georgia, places like Texas, they're restarting. Georgia this week is opening its restaurants. I want to see what happens when we unlock the doors and say, okay, we're back open for business. Do people return? Because if they return quickly and they come back in a big way, then that would suggest that the third quarter could be the rebound quarter and that the inflation story might be closer to us. Do they do like what happened in China? Because if you look at what happened in China, they started restarting in mid-March. They opened their doors. They said, we're here, we're ready to go. And for weeks, no one showed up. They were still afraid to leave their homes. If we get something like that, then the rebound looks like it's in the first half of next year, and there's still a lot more pain as well, too. So I'll watch things like the open table state of the industry data about reservations. I'll watch Apple Mobility. You can Google that. Google Mobility, they put out daily statistics about how much from your location data services are you moving around every day. I'm going to watch gasoline demand. It's down 40%. That's a weekly number. Does that rebound? Are we going to fill up our cars and start driving again? The faster we do that, the faster we are going to be at a rebound. And the question is, Are we waiting for stores to reopen? Is that all we need to do to have the rebound? Or are we waiting for ourselves to be more comfortable? It doesn't matter if the stores are open. We're waiting for ourselves to be more comfortable. I fear that's going to take a longer period of time than just announcing that the store is reopened.
So news today on a potential drug breakthrough seems like a pretty big deal then, and maybe an appropriate, maybe the most appropriate reason for a market bounce then, if that's the biggest issue, our own confidence and our own fear. Jim.
I agree.
Yeah, go ahead. Last thought.
Yeah, the market is really wants to see something that's going to give people confidence. And that's why the remdesivir trials coming up, with a positive result has gotten the market going. More so than any governor announcing that I'm going to open this state, or you could start golfing again in New Jersey, as Phil Murphy, the governor, said earlier today as well, too. It's something that's going to make people, as I like to say, because we're both in Chicago, you tell me the next time Wrigley Field can put 41,000 people in there for a game, and I'll tell you the day that we're all the way back. Is that this season? Is that next season? Is that 2 years from now? Is that 5 years from now? Is it never? I mean, where is that point that we go all the way back? And things like drugs that suggest that there is an effective treatment help get us a little bit closer. And that's why I think the market takes it so well.